All right, I was just told that I was muted, so thank you for that. Brian Wilson here, Market Structure Edge, September 25th. Great to see everyone. I appreciate you coming to today's session. It's a little bit different market today, isn't it? We have not had any downside pressure for quite a while. In fact, I was reading earlier that it goes all the way back to March trading. The last time that we've had 3 down days. That's amazing to even talk about. So we'll get into that. A couple of things just in terms of consideration for today's session. Excuse me. Questions are welcome. So please hit me up either on the chat line or raise your hand. During the course of the discussion, if you would just mute yourself. And I think really that's it. We have a number of topics to go through. Most of them should not take very long. And your questions are welcome. We're certainly in a little bit of a transitional period right now, so it'll be good to kind of talk through this together. So let's go ahead and get started. Couple more people to admit in. Okay, I think everyone's in. Okay. I mentioned this in a note a couple of days ago, and the discussion point was, are there days in which you should not be trading? Now, this is just a recommendation. Take it for what it's worth. But let me show you what I would avoid. And we try to provide this for you in the context, but also you can kind of look it up yourself. So on our webpage, just go to the expirations calendar for 2025, and you can see some of the upcoming dates. And these are the dates that I would avoid. So September right now, September trading, I did not trade going from Friday into Monday. So Friday was the conclusion of expirations. Friday was also S&P quarterly rebalances. And I never know what strategies are going to emerge as the focus shifts to the next series. So we went from, everyone had strategies in play through right here. This was a point in time. You could have the best setup in the world for a given stock, but we don't know if that setup's going to continue when we move to Monday. So personally, I didn't have any overnight trades going into Monday's trading. I will avoid those transitions from one expiration cycle to another. Most of the time, I will also avoid monthly transitions. So as we go from September into October trading, sometimes the same rules will apply. It's not quite to the same degree as one expiration cycle to another, but it's just something to be aware of. You can have things that are in play into the end of the month, and then those strategies and tactics can then change when you flip the calendar over to the next month. What other areas to avoid, or what other areas am I a little bit more cautious with? I'll still trade, but let's say last week in the middle of expirations, I was reducing my position sizes. Once again, it's the same thought process. As we go through expirations, I'm not sure if leverage trades are going to be rolled, just as an example. So expirations, I'll reduce my trade sizes. And also when there's just a little bit of market structure uncertainty. We're in the middle of it right now. I haven't decided yet if I'm going to place any trades at the end of the day. I'll probably see how the day proceeds. If I do place any trades at day's end, I'm once again going to be reducing my position sizes. So those are days in which I avoid trading, once again, going one expiration cycle to the next. I'll be cautious moving from one month end to the beginning of another month. Middle of expirations, I reduce my position sizes, and when there's market uncertainty, I'll be careful as well. I don't remember if I covered this topic in the note today. It might be a new topic for you guys. if so, I'll try to explain it. Um, it should be pretty straightforward. I'm going to pull up a couple of reports on the modern IR side. And what I want to show you is what we call trading patterns. And I'll explain what I mean by that term. So this is NVIDIA trading. And once again, this is what it looks like if we would, NVIDIA is not a client, but if we were to distribute a report to NVIDIA, this is what they would be receiving from us. Four different behaviors in the marketplace. We're measuring the interaction of those behaviors every single day. And then, of course, what happens over time. And the principle that I wanted to point out, and this goes back to the discussion about passive money earlier this morning, market behaviors tend to move in cycles in the market. They're not always going to be having greater influence. It's just the way that it occurs. This particular look on our report, and the reason that I'm showing it to you is just the impact that different behaviors can make in the market. In this case, a behavior that's above the zero axis means greater influence on pricing. And if you look at what was happening to NVIDIA, it was coming under pressure. Where was the pressure coming from? It was coming from active investors. So that's kind of the way to read that. The takeaway, once again, though, is that these different behaviors move in cycles. There's going to be periods where they have greater activity, and then there's going to be periods where they have lighter activity. That's what it means when they're below the zero axis. Let me pull up another example to show you what happens over time here. This is one of our clients on the modern IR side. And this type of behavior actually doesn't happen very often. What I'm going to show you is what active investors have been doing. This is Tudor Perini. It's what active money has been doing over the course of the last month. What do you see above the zero axis? A lot of active money sprinkled through there on a monthly basis. If you look at the actual numbers, you can see active money is elevated relative to their norms. Active investors have been buying the story. It doesn't happen very often that active money kind of moves in that manner, but they've been doing it for Tudor Perini, and that's part of the reason that they've been moving higher. Let me take you back to NVIDIA for a moment. I mentioned this in this morning's note. Here's part of the reason why NVIDIA has not been as strong recently. Look at their passive investment trends. Passive money's actually lower than their norms, lower than where they've been during the last 50 days as well. And that passive investment trend that I mentioned in today's note, that's part of what we're seeing across the S&P 500 right now. Whether it's the S&P 500 or the Russell 3000, what do we see right now? We see lighter overall passive investment support. What does that mean? Well, it means that we're not getting as much ETF flows. If you look at where passive money has been during the last 50 days, it's the S&P 500. There's your normative period. It's elevated. So it's been elevated for, let's call it, 2.5, 3 months. What's happening right now? That trend is moving lower. What happens in the marketplace when you have lighter support? Which behavior is moving higher? Fast trading. So the machines who are closest to the out order routers detect what's going on, who's coming, who's going. In this case, there's a lighter bid. There's a lighter bid from passive money. What's the path of least resistance then? Well, it's lower. And that's what the machines have been doing here during the last few days, is taking the market lower in the absence of investor support. So it's not necessarily investors selling the market right now. It's investors that have moved to the sidelines. And if you consider what passive money does in the marketplace, they tend to have a lot of activity going into big events like last week with expirations and rebalances. once that is done, and sometimes they're not going to have as much to do for a little while. I think we're in one of those periods at this particular time. Let me stop my screen sharing, see if I've missed any conversations here. Question from Joe asking about passive money. Yes, Joe, passive money is the 401ks, etc. If that's the case, if they aren't investing in the market, where are they moving the money instead? It just depends. Sometimes they're not moving it anywhere. It can be in cash. It can be going to fixed income instead of the equity market, or sometimes some of these passive models are just overweight. That what I showed you earlier in terms of the actual numbers, you can get to a point where you're perhaps overweight equities and you don't need to do any more buying for a period of time. We might be in one of those periods at this particular time. Um, Let me move our discussion for a moment. Let's see, Seb, did I miss your question? Uh, Seb has a question. Fast money, aren't they just buy and sell, or are they the cause of the specific stocks to go higher? They do both. So a lot of times what fast traders will do is they will exacerbate movement or amplify it, especially from active investors. They'll detect that active investors are in motion in the market and they'll go along with them. And essentially what they're doing is they're causing active investors to pay higher prices. There's also periods where they just detect an opportunity. I had a couple of stocks recently where they had been under a lot of selling pressure. Well, once the machines detected that the sellers were cleaned up, what was the path of least resistance then? Well, it was higher. So they'll amplify moves, they'll look for just kind of gaps and opportunities. And once sellers get cleaned up, they can take it higher. Or if there's no buyers in the marketplace, like we're seeing right now, with passive money being missing, they can just take the market lower. So, they can move it all on their own. They can amplify moves, but they don't necessarily need other behaviors to be moving in the marketplace. I wanted to share with you, this is a discussion we've had, but it probably goes back maybe 5 weeks or so. The discussion point is, what was happening in 2020 and what is happening now. Because our trading in 2020 has a lot of similarities to what we have right now. So this was us coming out of the pandemic back in 2020. This was, money moving in a huge fashion. And what happened because of that incredible demand? Well, short volumes rose to facilitate that trading. Now, it took a couple of months for shorts to start to get covered. You can see the pattern that kind of played out over time from a short volume perspective. And we had dips in the market. We rose, I forget the percentage, but it was an incredible rise from lows to highs that year. Along the way, we had 7, 5, 6, 7% moves lower. One of these was like a 10% move lower, but we continued to move higher. There are similarities between what we saw back then and what we see right now. So this is 2025 trading so far. Here's that basically the same exact surge in terms of just an incredible demand surge. What did that require? It required borrowing of shares to facilitate that trading. Took a couple of months. Once again, you see kind of the same short covering over time. We've had kind of a couple of minor blips, nothing like we saw with the pandemic. Perhaps this one is perhaps the most major one that we've seen so far. Do we continue to move higher? Don't know, but we can see some of the similarities that are in play, I think, between 2020 and between right now. Let me give you guys a reminder just in terms of momentum. Momentum works great until until it doesn't. And we've seen obviously that play out a little bit the last couple of days. I had to remind myself of this dynamic actually yesterday going into today. Here's our momentum portfolio. It's my favorite to trade, but also recognize that there's inherent risk that come with it. You know, what's the inherent risk? Just remember what the volatility is in a given stock, because the potential is that's what's been happening the last 5 days, movement from lows to highs. That's the potential in which it could go lower. So just be aware of that. I needed to remind myself of that same lesson with a recent trade that I placed. When momentum is working for you, you know, you obviously you love that upside, but it can go the other direction. If we look at today's trading, you know, what is the momentum portfolio doing? There's a few that are higher, but you know, I don't know what the intraday volatility is in Mara. That's probably most of it. So just be aware that that potential is out there. We all love to post the 8% gains, but you know, either set stop losses or be prepared mentally, you know, that some of those names can take out the full volatility if they go in the other direction. Let me circle back for a moment, see if I'm missing any questions. A question from Joe: if passive money is out of the market right now, would this almost be a buy the dip opportunity from a long-term investing perspective? Yes, we know they're going to come back into play at some point, Joe. It's just a question of how long, you know, they're going to be out of the market. I would imagine that they circle back into play the next couple of days. You know, why is that? Well, we have month end and quarter end activity. That's when we're going to tend to see true ups. Here's the question though, and I don't have a quantitative answer for this. I'll show you an eyeball answer here in just a moment, but looking at it from a chart and going back and looking at it over time, two different matters. The question is, you know, are market participants overweight or underweight coming into the end of the quarter? And I'll show you the chart here in just a second, Joe. Is there an average amount of time that passive money normally sits out? Well, of course, they never sit out, and I probably use that term incorrectly. They just have periods where they have less influence. So, you know, if they were 27% of trading last week and they're 25 and a half this week, they're still having influence, just not the same that they did previously. In terms of those cycles, usually 5 to 7 days at a time is kind of that typical cycle that we'll see. Let me show you the eyeball test here in a second. Recognize it for what it is. It's not quantitative. Um, and even if it was quantitative, there's a lot of factors coming into play at the end of a quarter that we're not aware of. What do I mean by that? You know, have equity models changed behind the scenes? You know, are certain investors just devoting lighter overall money to equities? You know, so you have things going on behind the scenes that we're not sometimes privy to. Here's the eyeball test, and it works on the chart. Once again, take it for what it's worth. It's not quantitative at all. It kind of goes along with my market desk note from, I believe, last week, where I was talking about those bodies in motion. They tend to stay in motion. Look at what's happened here during the course of this year. After we get done with this exercise, I'll take it back to last year. If markets are generally falling into quarter end, what tends to happen at the end of the quarter? Well, here was quarter end in March. Markets came under additional pressure. By the way, that was the last time that we had a 3-day move lower, was right there at quarter end in March. We look at June. Markets had been moving higher. What's the eyeball test? Well, markets continued to move higher into the end of June. Let's take it back to last year. I won't go further back than that because it becomes a little bit too hard, too difficult to see. If we look at September going into year end, uh, markets had generally been moving higher. We got a little messy here for a while. What did the markets finally do at year end? Went up a little bit. So once again, that's an eyeball test. That's not quantitative. So take it for what it's worth there. But just recognize that we do have month end and quarter end coming up, and I'm back on our S&P 500 report right now. And with passive money recently having lighter activity across the market, I think we probably get passive money coming back into play. The Newton law says passive money is probably buyers, but once again, that's not quantitative at all. That's just the eyeball test recently with the market. Let me take you back for a second, and I'll introduce just one other concept to you guys. It has to do with the trading patterns. Let me enlarge this just a little bit so you can see it. So this is one of our clients on the IR side, and I wanted to share with you sometimes how these behaviors work in the marketplace. Once again, you're looking at the patterns look. Behaviors above the zero axis represent greater influence. And I'll walk you through what you're looking at here on this chart. For this particular company, ACIW, if you took it back farther, they'd been coming under a lot of pressure going into August month end. What we see immediately at the beginning of August, we see blue in the trading patterns. In fact, we had blue for about 2 weeks. What's blue? It's active money. What were they doing? They were taking a stand. So shares had been under a lot of pressure. Active money takes a stand, and they basically created or helped to create a snowball effect. This doesn't happen very often, but I just wanted to share with you what will occasionally occur. So active money takes a stand. Notice who starts to join them. Passive money starts to join them. So we get quants that get interested. Who starts to go along for the ride? Fast traders do. So fast traders detect this momentum that's been in play. They continue the rally, and then that continues, for another session there with active investors. So once again, 4 different behaviors in the marketplace. As a general rule, and this is a little bit of an exception, we tend to get passive money that tends to be kind of the impetus for overall trading. So if you're looking at the charts and let's say that you're looking at a sector, just we'll take a sector for instance. So we look at communication services. Right now, it's being led by fast traders. Well, that's machine-led activity. What about consumer staples? Well, it's passive investment trading. Those different behaviors, recognize the overall impact that they have in the marketplace. Passive money tends to be about 25, 26% of trading. And as I mentioned earlier, when those flows are moving along at a predictable pattern, well, everyone else kind of keys in on those flows. In fact, a lot of times active investors will call it closet indexing. And what that means is active investors will just kind of tag along with what passive money is doing. So passive money a lot of times tends to be kind of the first movers. When you get those flows, it's going to kind of trickle down to everyone else. Fast traders tend to exacerbate some of that movement. Sometimes they'll detect activity and just kind of go along with what's occurring. And active money, the only behavior that cares about fundamentals, they're acting on the stock story. They don't move the market like the other behaviors. It's impossible because they're 10% of actual trading levels. And let me for a moment go back for a second and explain what these numbers mean. So if you have 100,000 shares trading, just as an example, this would mean that 10,000 shares is coming from active money, 25,000 from passive money, and so forth. So that's looking at the actual, trading levels there at the end of the day. Let me circle back, guys, see if there's any other questions. Don't think there's any other questions that have come in so far. Let me see if I'm missing anything from what I wanted to present today. I think I've covered most of the points that I wanted to cover. Let me go ahead and go to our segment that we call, what's ahead. So, what am I expecting to happen here as we look ahead? Obviously, trading has been choppy recently, and if we look at the overall setup, it's good. If passive money was flowing right now, this is a pretty good setup. Market structure sentiment is 5.3. That's a very solid number. We've been stuck for a little while, haven't we? So we've been stuck kind of moving sideways. Short volume is appropriate. We've been getting some recent short covering. I like to include the big tech look. So I'm trying to keep, what's going on from a big picture perspective. Is it aligning with what's going on in big tech? Because big tech is, 34, 35% of the market. Well, big tech sentiment is very strong at 7.1. Short volumes are low as well. So from a structural perspective, there's not necessarily any issues to address here. What becomes a potential issue is if both of those start to fade. If big tech starts to fade, if market structure sentiment, fades below neutral, then those become an issue. And guys, I think I will leave it there. As we look ahead, of course, we're going to be coming up to both month end and quarter end. I think I took it down. Let me see if I still have it. Okay, so we're coming up to this period right here. That's once again the month end time frame. In this case, it's going to be quarter end positioning as well. And I think some of the trading that we've been seeing in the market recently, you have to recognize that for some of these names, let me go back to Tudor Perini as an example. So we're looking at a specific company right now. What I wanted to share with you is how difficult it is to trade in the marketplace. So if you're an active investor and let's say you hold 50,000 shares of Tudor Perini, how difficult is it to get in or out? Well, you're trading 52 shares at a clip. That's how difficult it is to get in and out. So if you see active money, moving for a period of time, sometimes it's because they're either adding to a position or trying to get out of a position. I showed you this chart earlier, huge rally over the course of the last month. And we see the blue in the trading patterns. It's obvious that active money has been trying to add to positions, but it's so very difficult for them to do so. What happens as they do that? Look at the yellow in the trading patterns. That's fast traders that are going along with that buy interest. It could very well be the other direction as well. Just, recognize that these behaviors tend to go along with each other. Fast traders will tend to amplify or exacerbate, what is happening there in the market. Let's see, Brad. Let me see. I must have missed your question. Sorry about that. Uh, Brad was asking whether the displays we're showing from modern IR, is that data available in Edge? Brad, it is not. Maybe at some point in the future we'll be able to add some of those things. It's part of the reason why in our desk notes we share with you if there's big trends going on, with the actual numbers. It's why I share intraday volatility. It's why I share what's been happening with those passive investment trends as well. So we do try to share that info with you in the notes. if it's something that we feel is meaningful. Guys, can I answer any other questions for you today? Did I thoroughly confuse everyone? I know we touched on a couple of subjects that we haven't before, and hopefully it was helpful. It's the interaction of four behaviors in the marketplace, and we have to remember that all four of those behaviors are after different things. Active investors care about fundamentals. Passive investors care about characteristics. A lot of times that is, market cap, sector, volatility. They're owning a particular company because of those characteristics. Fast traders, they're making markets, they're exacerbating those trends. Risk management comes into play, with leveraging and hedges to keep it simple there. But four different behaviors, and they're going to be operating at different times, and recognize that we're coming up with passive money where they will probably be coming back into play once again for month end and quarter end adjustments. The eyeball test says maybe it goes higher, but I don't know what's going on behind the scenes, right? I don't know if some of those passive models are overweight at quarter end. If that's the case, then we could have continued selling. But I do expect passive money to return. I just don't know in what capacity. Rebecca has a question. Good question, Rebecca. Will you summarize which behavior goes first, second, etc.? It differs in the marketplace, but I'll move back to that S&P 500 report for a moment to share with you what normally happens. So passive money is between about 25 to 27% of trading. So as index fund, as ETF, as quant fund flows come into the market, whether buying or selling, that tends to be kind of the first influence. Fast traders, once again, are just going along with the trends. They tend to be a secondary influence. They can be a primary influence at times, not as often. Active money by default, by being 10% of order flow, they're going to be back towards the back of the bus. They just don't influence things as much as they once did. When I was a buy side trader in the late 90s, early 2000s, active money was 80% of trading activity. So it's a very, very different world that we're in right now. And it's part of why we have to pay attention to what the four behaviors are doing, and not just active money, the CNBC type crowd. Well, guys, I think that's it for today. I am going to stop the recording unless there's any last minute questions. If not, thanks so much for your attention today. We'll have this up on our YouTube page hopefully later this afternoon or this evening. Hope you have a great rest of the day.